Welcome back. You're watching The Money Show. Now, investing is all about human psychology. And, well, just think back to when you were a child. How did you learn that fire is hot? Or, in fact, that you shouldn't touch the tea kettle just after it's been taken off the gas? Well, there were certain experiences that taught you that. And when it comes to investing, fortunately or unfortunately, it is those experiences that teach you how to invest. So when there is a bull market, there is a sense of euphoria, but at some point of time, there is a big crash, and sometimes investors end up burning their fingers. Now, we're going to be talking about human psychology and how best to utilize the volatility in the market, because as they say, volatility is actually your friend, but you need to be able to make friends with volatility. My guest today is Ashwin Patani, Head Products and Alternatives at Axis AMC. I would like to thank you, Mr. Patani, for joining in and for taking the time.
Okay.
And it's very interesting. You've done a study. You've gone back over the last several years, and you've looked at the performance of the benchmark and the behavior that investors have had, and you have a few very interesting learnings. What is that all about?
Yeah, hi, hello, and good evening, everyone. And yes, it's really is a very I should say, a burning topic for all of us here, because we have seen yet again in the last 12 months what the markets are capable of in terms of volatility, both on the equity and debt side. And investor behavior is something that every time we go through these type of sort of stomach churning episodes, we see the investor behavior reacting to that as well. So basically, just to give a quick background, what we globally, it's been something that has been very widely studied, investor behavior. And there are lots of organizations who look at how investors lose out when you get in, get out at the wrong time. A very easy example to explain this is if you get in and invest when the market is booming and at a new high, but redeem or stop investing when the market goes through a correction, intuitively we can all understand that that is not something that will help us make the optimal amount of returns that we can make from the market. So globally, it's been a pattern which has been studied well. But despite the size of our industry in India, the kind of sort of the time period, last 25-30 years the industry's been around, there's not been really much study on the cost to investor behavior of sort of this volatility. And therefore, we started doing this at Axis over the last few years. We've done 3 editions of that, and we recently sort of updated our data for 2020, which was a very landmark year for the kind of volatility we saw. And essentially, our objective was very simple. If you could just invest in an asset-weighted manner, basically across the entire mutual fund industry, of course, practically nobody can, but what is the return that somebody would have got, essentially, if you had just remained invested for the last 18 years on equity funds? And actual return that investors may have got, because they obviously have not remained invested, but we have seen positive inflows, redemptions, going in and out. Just in the last 3 years, for example, 2018-19 saw heavy positive inflows, 2020 saw heavy redemptions. So this keeps happening, right? So actual inflows, outflows of the investors, what has been their actual experience? And the findings were quite sobering, as you would expect. But even though we were prepared to get the findings which were sobering, the results are still quite stunning. Just to share the big numbers on the equity side, over the 18 years compounded compared to an 18.7% that the asset-weighted mutual fund industry equity funds have returned, investor return according to our calculations has been 5.5% lower than that. So that's a staggering sort of, practically, wiping away almost 30% of the returns that are available from the category purely on account of sort of behavioral sort of challenges. And that is something that we have seen across. So we did this study across equity funds, hybrid funds, as well as debt funds. And unfortunately, the observation has been the same. The extent has been a little different. But equally in all the scenarios, investors have lost out. Just for sake of comparison, we also said that the very easy mode for all investors in this today's day and age is what is called the SIP, the regular investing option, the systematic investment plan. And even if you compare investor returns to the SIP over the long term, even there, they are much, much worse. So in short, to summarize, this behavior of not investing in a stable manner and getting spooked by greed and fear cycles is something that is causing investors to be very erratic with their investor behavior, and that is causing very real damage to their portfolios over the long term.
I want to talk a little bit more about the second point that you raised, which is the graph that you've displayed, Ashwin, with regard to the SIP and the movement of the index, right? Because it points to a very telling story in that whenever you see a big crash, you also see a drop in the kind of investments that investors are willing to make. And ultimately, the greed and fear plays out in that respect. It's that when markets crash, that is when you should be looking to average, and that's the story that we've displayed even in 2020, right? When you saw the big crash in March, the people that have made the money over the course of 2020 are the ones that bit the bullet and said, look, I am very sure that I'm putting money in for the next 15 years, and I'm sure about the story of growth here in India. My objective is not to pull money out now. I need money only in 15 years, and therefore I will stay invested. But that seems to be not a lot of people, unfortunately.
So that in fact, when we did this analysis on the SIP numbers, that was in fact doubly saddening if you ask me, because you, to a certain extent, a lump sum investor getting scared by market volatility is something that, while obviously it's not ideal, but that is something that you could see what was happening. But if you imagine an investor who's signing up for an SIP, typically SIP tenures 3-5 years, in most cases can be even longer. And for someone who's committing to allocating money over the next, let's take 5 years as an example, over the next 60 months, to take a decision on canceling that SIP or not continuing with SIP based on what is happening in this month, which will affect 1/60th of that allocation, is something that is really something that we are troubled about, because that's obviously not ideal behavior. The numbers were staggering. If you see the net SIP additions to the industry, which means basically either when investors coming in the form of new SIPs, but reduced by those investors who are choosing to cancel their existing SIPs. So what are the net additions which are happening? And the dramatic way in which it has tagged what it was doing in the market. So when the markets are at a high, people are happy to open new long-term SIPs, and when the market are a new, either they are stopping new SIPs or canceling existing ones, which is really like I said, doubly saddening, because not only are we reflecting today's flows, but you're actually taking a long-term 5-year, 10-year allocation target based on what is happening in the market today, which is completely unfair.
You know, let's talk then about the ideal strategy and what an investor should bear in mind. Unfortunately, Ashwin, it's the easiest thing to stand on the outside and to say, hey, you know what, you need to leave psychology at the door and you need to be this ice cool cucumber, if you can call it that, and say that you don't need to get affected with a 1,000-point fall on the Nifty or a 5,000-point fall in the Nifty. It's eventually going to come back. That's the easiest thing to do. It's very hard to actually put that into practice. So, how is there a way to do that?
Absolutely, very, very good question, and absolutely something that everyone needs to think about, because as you started off by saying, our psychology has been set in place by billions of years of evolution. We are not going to be able to change the way we think, even if, despite whatever our best interest is, our best efforts are, the reality is that we are hardwired to react in a certain way. And which is why over the last 20-30 years, behavioral finance is one of the fastest emerging field within finance. And clearly there are a few rules of thumbs that we can take to protect ourselves. And for example, something like SIP, why is it so brilliant? Because it automates the decision of putting money every month, and it sort of separates that, because every time you take the actual decision of investing, there is always an element of regret that can come in, because if you invest today and the market falls tomorrow, then you sort of start questioning yourself, saying, did I act too soon? Was I wrong in my decision? And the minute you sort of automate that decision, and you let it happen automatically at the back end on a every month basis without really, then you're separating the emotion from the action, and that allows you to be a little bit better and more comfortable about it. So that's maybe one way, which is to sort of automate as much as possible, systematize as much as possible. That's one thing. The second is sort of to not look too often. It's really tempting to look at, one has started investing, especially when markets are doing well, to go back and check every day how the NAVs are, check every week what is happening to our investments. Reality is that if we have invested for the long term, daily, weekly changes are not really going to have a very material difference to the overall plan. So have that discipline that the review should be periodic, review should not be too often, because then it sort of also forces the itch on us that we should take some action every time we keep looking at it, because it just keeps impacting us more. So that's something. And the third, maybe I would say finally, is that maybe have a pre-agreed plan. So when we are investing, you have a pre-agreed plan that what will I do if the market goes up 20%? What will I do if the market goes down 20%? If we have thought about this in advance, then we are not struggling when the market actually prices us. And then we are not taking decisions completely emotionally, because when we think about this in advance, we can be a little bit more rational. Sitting today in April 21 to say that over the next 6 months, what will be my plan of action if in this year, if the market corrects 20% plus? Will I add? Will I do not add? Think about it today without any emotional baggage, and write it down saying this will be what my plan is, so that when the market does that, you can at least revisit that, and it allows you to have some sense of balance rather than completely reacting in an emotional manner to that event.
Ashwin, just to close out this conversation now, and my question here is to one of the points that you raised, which is to automate and which is to have periodic checks. Now, the question here is to say that if you look at 2020 and the kind of gyrations that you saw, I would actually think that if you had a predetermined asset allocation in your portfolio and said that you have 60% allocated towards equity and 40% towards debt, if it suddenly moved to a 40-60 on the other side because equity has crashed so dramatically, do you move then? And in a situation where you're seeing humongous volatility, do you reduce or scrunch up the kind of periods that you check that allocation?
So definitely, if there are such a dramatic happenings, dramatic situations playing out in the market, you have to keep track of them. It's one thing to say that don't look at the market on a daily basis on a 2-3% move, and quite something else when the equity market suddenly falls 30%, 40% over a month. That's obviously something that will require everyone to just take stock in terms of what has happened. And which is where I feel that if you had set certain things, that will allow you to take sort of cool-headed decisions on what is to be done. You said it perfectly right. For example, if you have an asset allocation target, 60, 40, 50, 50, whatever it is, and you plan in advance saying that market falls down, then typically my asset allocation will get skewed. So therefore, I'll need to move some of my debt allocation into equity to get it rebalanced. Then if you've thought this thing through in the cool times, then when this happens, it makes it easier for you to decide, okay, this is what I had planned. Why not I try and check what has happened, and allows us investors to take the decision. So absolutely, yes, big dramatic moves in the market cannot and should not be ignored. People should take stock, but ideally they should avoid taking decisions purely reacting to the emotional impact of those moves, because that really will be damaging.
And we've seen that that is in fact the case. Ashwin Patani, it's been an absolute pleasure speaking to you. Thank you so much for taking the time and for sharing your insights on this program.
Thank you.
All right, on that note, Let us slip into a short break. On the other side, we've got more, so do stay tuned. This is ET Now.